There are thousands of indicators claiming that they can predict Bitcoin. RSI, moving averages, MACD, on-chain metrics. Then there are the experts, people who have spent decades studying the financial markets, each with their own theory of where Bitcoin is headed next. Now with the rise of AI, many people believe AI can finally do what humans can't. Then there is macroeconomics, interest rates, liquidity, inflation and the economy itself all have a huge impact on financial markets. But can they actually predict Bitcoin? And finally, there's Bitcoin's own history, a pattern that some people believe repeats every 4 years. Every one of these approaches claims to have an edge, a way to know when to buy or to sell, or at the very least, what Bitcoin is most likely to do next. So I decided to put them all to the test. Over the past few days, I compared technical analysis, some of the biggest names in the Bitcoin industry, AI, macroeconomics, and Bitcoin's history to answer one question. Can anyone actually predict Bitcoin? And by the end of this video, my answer wasn't what I was expecting. Let's start with probably the most common way people try to predict Bitcoin, technical analysis or TA. If you have spent time in crypto or other markets, you have probably seen charts with lines, indicators and different patterns. Some traders swear by them, others think they are nothing more than financial astrology. So I wanted to find out, do they actually work? Let's start with one of the simplest and most popular indicator, the moving averages. For this video, I'm only using the weekly time frames since we are looking at Bitcoin from a long-term investing perspective. This is the 50-week moving average. All it does is calculate Bitcoin's average price over the previous 50 weeks and plots it in as a single line on the chart. At first glance, it doesn't look like anything special. But once you overlay it across Bitcoin's entire history, a pattern starts to emerge. Whenever Bitcoin traded above the 50-week moving average, the market was generally in a bull trend. Every time the price pulled back to this line, buyers stepped in and the trend continued. Then eventually every bull market broke below it, and once that happened, Bitcoin entered a bear market. The opposite was true as well. When Bitcoin eventually reclaimed the 50-week moving average after a bear market, a new uptrend had already begun. That sounds pretty useful until you notice one important detail. By the time Bitcoin breaks below the 50-week moving average, the bull market top has already happened. And by the time Bitcoin breaks back above it, the bear market bottom is already behind us. So while the 50-week moving average does a great job of telling us whether we are in a bull market or bear market, it doesn't predict the exact turning point. It confirms them, and that's an important difference. So if the 50-week moving average is better at identifying trends than reversals, maybe a different moving average can do better. That brings us to one of the most respected indicators in Bitcoin's history, the 200-week moving average. Unlike the 50-week moving average, the 200-week moves much slower because it's averaging almost 4 years of price data. It can never keep up with Bitcoin during a bull market. The price simply moves too fast. That means it's useless to predict bull market tops. But bear market bottoms tell a completely different story. Looking back through Bitcoin's history, something interesting starts to appear. After the 2013 bull market, Bitcoin spent all of 2014 and early 2015 in a brutal bear market. And right at the bottom, the market found support almost exactly on the 200-week moving average before beginning the next bull market. The same thing happened again in 2018. Bitcoin fell for around a year before finding its bottom right around the 200-week moving average. At this point, it looks too good to be true. 2 major bear markets and 2 major bottoms, the same indicator. So naturally you'll think you've found the perfect buy signal. But then came the 2022 bear market. For the first time, Bitcoin didn't stop exactly at the 200-week moving average. Instead, it traded below it for a period before finally putting in its bear market low. Now, if you had bought around the 200-week moving average, you will still have made an excellent long-term investment. But the indicator proved something important. Even one of Bitcoin's most reliable signals wasn't perfect. Fast forward to today. During the current 2026 bear market, Bitcoin has once again tested the 200-week moving average and so far have held it. Does that mean the bottom is already in? We simply don't know. History tells us we are either very close to our bottom or maybe the bottom is already behind us. But it doesn't give us certainty. Moving averages are incredibly useful. They help identify trends. They highlight important support and resistance levels. They give context, but they don't consistently predict Bitcoin's tops or bottoms. So if moving averages couldn't consistently predict Bitcoin's major turning points, maybe momentum can. That's where one of the most famous indicators in technical analysis comes into play, the Relative Strength Index, or better known as the RSI. The RSI measures momentum on a scale from 0 to 100. When it's above 70, Bitcoin is considered overbought, meaning many traders believe the market has gone too far, too fast, and is due for a correction. Below 30, it's considered oversold, suggesting the opposite, that Bitcoin may be close to a bottom. It sounds almost too simple. Buy below 30, sell above 70. If only it were that easy. Let's start with the overbought side. Looking at Bitcoin's weekly chart throughout history, one thing becomes obvious almost immediately. If you had sold every time the RSI crossed above 70, you would have missed some of Bitcoin's biggest moves. During the strongest bull markets, the RSI didn't just reach 70, it pushed above 90. Bitcoin kept climbing after most traders would have sold based on the RSI. What's even more surprising is that some of Bitcoin's biggest cycle tops didn't even happen at the highest RSI readings. The market would cool off, the RSI would fall, and then Bitcoin would continue making new highs. That's because momentum can slow down while the price moves higher. So if your goal is to predict the exact bull market tops, the RSI is simply not reliable. But the bearish side tells a different story. Looking back at Bitcoin's history, every major bear market pushed the weekly RSI into the oversold zone. In the previous 3 completed bear markets, those oversold readings occurred at the bottom or very close to it. Now we can't include the current 2026 bear market in the conclusion because we still don't know where the final low will be. But based on Bitcoin's historical data, the RSI had done a good job of highlighting when the reversal was about to happen after being oversold. Does that mean the moment Bitcoin drops below 30 you should buy everything? Not necessarily. Just like the moving averages, it isn't a crystal ball. But when Bitcoin enters the oversold zone, history suggests we are entering a period where major bottoms tends to happen. And that's a valuable piece of information. After looking through Bitcoin's history, that became my biggest takeaway from the RSI. It's much better at identifying periods of fear than periods of euphoria. It struggles to tell us exactly when a bull market is ending, but it has repeatedly highlighted when a bear market was close to putting in its bottom. So once again, the indicator wasn't useless, it just wasn't perfect. And after testing another one of Bitcoin's most popular indicators, the pattern was starting to become clear. Technical analysis wasn't giving me exact predictions, it was giving me probabilities. So far, technical analysis has been surprisingly useful. The moving averages help identifying trends and key support and resistance levels. The RSI helped identifying periods where Bitcoin was oversold, but neither of them answered one important question. At what price should Bitcoin actually reverse? That's exactly what Fibonacci retracement levels try to solve. Unlike moving averages or the RSI, Fibonacci isn't trying to tell you whether Bitcoin is bullish or bearish. Instead, it attempts to identify levels where buyers or sellers might step in. To create Fibonacci levels, you simply draw from a major low to a major high. The tool then creates these levels that often act as support or resistance. So let's apply it to Bitcoin. Using the most recent bear market low and the most recent bull market high, we get several key Fibonacci levels. Looking at the chart, you can immediately see that many of these levels have acted as support and resistance throughout the cycle. Not perfectly, but often enough that they're worth paying attention to. Now let's flip the analysis. Instead of drawing from the low to the high, let's draw it from the bull market top down to the bear market low. At first, nothing really stands out. But after comparing multiple Bitcoin cycles, I noticed something interesting. The area between the 0.236 and 0.125 Fibonacci levels repeatedly lined up with where Bitcoin eventually found its bear market bottom. Not on one exact Fibonacci level, but within that zone. And I think that's the key. Too many people treat Fibonacci levels as exact prices. I don't. Markets rarely reverse at the exact dollar. Instead, I think they are much more useful as areas that are worth paying attention to. If Bitcoin enters one of those historical support zones, maybe it's time to stop thinking that the market is gonna collapse forever. Maybe it's time to slowly shift your mindset from bearish to bullish. Not because Fibonacci predicts the future, but because history suggests that these level matters. And after testing some of Bitcoin's most popular technical indicators, one conclusion kept coming up over and over again. Technical analysis is incredibly useful. It helps identify trends, momentum, support, resistance, and important price zones. But none of these indicators consistently predicted Bitcoin's tops or bottoms. Instead, they gave us something much more realistic: probabilities. And that's an important distinction. So if the charts themselves can't predict Bitcoin, maybe the people who have spent decades studying these markets can. Every analysis has a different philosophy. Some focus on macroeconomics, some build mathematical models, others rely almost entirely on technical analysis. One of the most respected long-term Bitcoin analysts is Benjamin Cowen. Unlike many analysts who try to predict exact prices, Cowen's approach is centered around probabilities, risk management, and understanding where Bitcoin sits within the larger cycle. One idea he returns to over and over again is Bitcoin's historical 4-year cycle. Instead of trying to predict the exact day Bitcoin is gonna top or bottom, he looks for periods where history suggests that risk is increasing or decreasing. So naturally, I wanted to see if there was actually something to it. Looking at Bitcoin's most recent bull market, the top happened in Q4 of 2025. If Bitcoin really does move in roughly a 4-year cycle, then going back 4 years should reveal something similar. Sure enough, Q4 2021, another major bull market top. Go back another 4 years, Q4 2017, again Bitcoin topped during the same general period, And another 4 years back, Q4 2013, once again the market topped, and afterwards a bear market followed, just like every other time. Now these weren't the exact same day, they weren't even the exact same month, but they all occurred within the same general window. And that's exactly how Cowen thinks about the market. He is not trying to predict the exact top or bottom. He is trying to identify periods where the odds begin to shift. Of course, the 4-year framework is only one part of Benjamin Cowen's approach. He combines with many other indicators and risk models. But after seeing this pattern repeat, I couldn't help but wonder, was this just a coincidence, or was there something much bigger hidden in Bitcoin's history? We'll come back to that later. Benjamin Cowen's approach is built around Bitcoin's history, but not every analyst believes history is the best place to look. One of the biggest names in macro investing, Raoul Pal, approaches Bitcoin from a completely different angle. Before making this video, I honestly hadn't looked that deep into his work. I spent some time watching some of his speeches and listened to a podcast to better understand his approach to Bitcoin. One thing quickly became clear. Raoul doesn't really begin with Bitcoin. He begins with the economy. His beliefs is that Bitcoin is just the final step of a bigger chain. In its simplest form, his framework looks like this: RSM, business cycle, liquidity, and Bitcoin. So before we can understand why he believed that this cycle was different, we first need to understand the very first piece of the puzzle, the ISM index. The RSM measures the health of the US manufacturing sector by surveying purchasing managers across hundreds of companies. The number itself is actually really simple. Above 50 generally signals economic expansion. Below 50 suggests the economy is contracting. Raoul believes the RSM is one of the most reliable indicators of the business cycle. And since the business cycle drives liquidity, he ultimately believes it can tell us a lot about where Bitcoin is headed. Historically, he argues that Bitcoin's biggest tops and bottoms have often had a relationship with major turning points in both the RSM and liquidity cycle. That way of thinking eventually led to one of his predictions. Traditionally, Bitcoin has followed a roughly 4-year cycle pattern, much like Benjamin Cowen's framework. Raoul believed this current cycle would be different this time, not because Bitcoin had changed, but because the economy had. His idea was that the global business cycle had been delayed. Interest rates stayed at zero much longer than expected. At the same time, a huge amount of debt had its maturity pushed further into the future. Instead of much of that debt needing to be refinanced during 2025, it had been delayed until 2026. And if the business cycle is delayed, liquidity is delayed. Bitcoin's cycle is delayed too. That's what he believes. He also follows a business cycle model lasting roughly 5.4 years. According to that model, liquidity wouldn't peak until around Q4 of 2026. If Bitcoin continued following liquidity as it had historically, that would also suggest a later Bitcoin cycle peak. When Raoul first presented this idea, it actually made a lot of sense. The markets were expecting the Fed to continue cutting interest rates. Lower interest rates generally creates easier financial conditions. Easier financial conditions usually leads to more liquidity entering the system. Raoul also pointed to the RSM itself. At the time, it wasn't even above 50. Even now, while I'm recording this video, it's only around 54 and still hasn't clearly reached that kind of cycle peak that has historically lined up with Bitcoin's biggest market tops. So from his perspective, why would Bitcoin already be at its final top when the macro environment hadn't topped yet? But markets don't always follow expectations. When Raoul first presented this idea in late 2025, the macro environment has developed differently than what most people were expecting. Interest rates stayed higher for longer. Markets began expecting fewer Fed rate cuts. Inflation remained more persistent. Energy prices increased. And geopolitical uncertainty created additional pressure across financial markets. As a result, the liquidity expansion that most investors were anticipating didn't really play out as expected. Now, whether Raoul's predictions proves right or wrong isn't really what interested me about him. Biggest thing I took away from researching him was his mindset. On the Diary of a CEO podcast, he says something that stood out to me. I don't make predictions because a lot of people listen to what I say and then they build a mental model around a price that creates comfort instead of making people think for themselves. I think that's one of the healthiest investing mindsets I came across while making this video. He's not trying to convince people that Bitcoin is gonna reach a certain price on a specific date. He's encouraging people to build a framework and continue testing that framework as new informations become available. So even though this idea is probably not gonna play out, his long-term conviction hasn't changed. He still believes digital assets could still grow to 100 trillion over the next decade. Whether that's gonna happen or not, I think the biggest lesson from Raoul isn't the prediction, it's the way he thinks. Have conviction in your long-term idea, but never become emotionally attached to it. Because markets evolve all the time, and your thinking should evolve with it. But while Raoul tries to understand Bitcoin from the economy, another analysis has a completely different approach to Bitcoin. Instead of studying Bitcoin's history or macroeconomics, this analysis believes Bitcoin's future can be explained through mathematics. And that brings us to Plan B. If you have been in Bitcoin for a while, you have probably already heard about him. Like many analysts, Plan B studies charts and uses technical indicators such as the RSI, moving averages, and realized price. But the model that made him one of the biggest names in Bitcoin analysis was something called stock to flow. Interestingly, he hasn't uploaded a Bitcoin market analysis video since December of last year, although he still regularly shares his thoughts on X. But what actually is the stock to flow model? Despite what many people think, it wasn't originally created for Bitcoin. For decades, economists have used stock to flow to measure the scarcity of stuff like gold and silver. The idea itself is surprisingly simple. The model compares the total amount of an asset that already exists, the stock, with the amount of new supply created each year, the flow. The higher the ratio, the scarcer the asset becomes. Bitcoin is unique because every 4 years the halving cuts the amount of Bitcoin entering circulation in half. That means Bitcoin becomes increasingly scarcer over time. Plan B took this idea one step further. Using regression analysis, he compared Bitcoin's stock to flow ratio with its market funding. His conclusion was straightforward. As Bitcoin becomes scarcer through each halving, its value should increase over the long term. Leading into this last bull market, the model suggested Bitcoin could eventually reach somewhere between roughly $250,000 and $1 million per Bitcoin, with around 500,000 sitting near the middle of the model. Like many other analysts, Plan B was expecting way more upside than what we ended up seeing in the most recent bull market. But stock to flow wasn't the only tool he relied on. He also pays close attention to the RSI, Interestingly, he doesn't use it the same way most traders does. Rather than trying to predict exact tops or bottoms, he uses it to understand what phase of the market we are in. For PlanB, an RSI above 80 represents the euphoric phase of a bull market. Around 30 represents a deep bear market. One of his ideas is that if Bitcoin never reaches that euphoric phase above 80, maybe investors don't need to expect that deep bear market phase around 30 either. Again, it's less about predicting exact turning points and more about identifying the current market environment. But just like the other frameworks we have looked at, reality didn't play out as expected. Bitcoin wasn't even close to the prices that the stock-to-flow model suggested, and the RSI never reached that euphoric phase that PlanB was expecting. Like many analysts during that bull market, his view was just too optimistic. But I don't think that makes the model worthless. One thing I really like about PlanB is something he says quite often. All models are wrong, some are useful. Technical analysis didn't consistently predict Bitcoin. Benjamin Cowen's historical cycle isn't exact. Raoul Pal's macro framework continues to evolve. And stock-to-flow didn't accurately predict this cycle either. But again, I don't think that makes any of them useless. Every one of them offers a different way of understanding the market. Technical analysis helps identify trends. History gives us probabilities. Macro provides context. And mathematical models help explain scarcity. Maybe the mistake isn't using these frameworks. Maybe it's expecting any single one of them to predict the future on its own. That left me wondering, what if you combined all of them? History, technical analysis, macro, millions of data points. That's exactly what modern AI claims it can do. AI has access to more information than any individual investor could ever have. It can analyze charts in seconds, explain technical indicators, recognize historical patterns, and process huge amount of data almost instantly. So if anything was finally going to solve the prediction problem, it surely would be AI. I decided to find out. Testing AI using today's market wouldn't really tell us anything. We still don't know where Bitcoin will be in 6 months from now. So instead I went back to previous points in Bitcoin's history where the future already had happened, but was completely hidden from the AI. I removed the dates from the charts, hid future price action, and gave the same prompt to the 3 different AIs: ChatGPT, Gemini, and Claude. The exact same indicators and the exact same instructions. Their task was simple: analyze the chart as if it were happening live, explain the reasoning behind the analysis, and predict where Bitcoin's price would likely be 6 months later. To make this experiment as fair as possible, I repeated this 3 times with 3 completely different charts. Test 1. The first chart came from around the 2018 market top. 6 months later, Bitcoin was trading at roughly $6,400. Gemini correctly expected the market to move lower, but its price tag was still a long way off. ChatGPT was completely off. Claude, however, produced a much stronger result. It predicted a range between roughly $6,000 and $10,000. It wasn't perfect, but compared to the other models, it was surprisingly accurate. Another thing that caught my attention was confidence. All 3 models rated themselves somewhere between 70 and 80% in confidence, despite reaching different conclusions. At that point, I thought Claude had simply done a really impressive job. Then came the second test. The setup was exactly the same prompt, same indicators, just a different historical chart. 6 months later, Bitcoin was trading around 55k. Gemini and ChatGPT correctly identified the bullish direction but underestimated the final price. Claude's prediction, 55k. This time it was spot on. At that point I honestly started questioning this experiment. Had Claude generally analyzed these charts that well, or was there something else going on here? So I asked it directly. Even though I had removed all of the dates, Claude explained that those charts represented some of the most well-known periods in Bitcoin's history and that it had likely encountered very similar examples during training. That was a really important moment, because if Claude could recognize these patterns, it could also get the price perfect instead of actually making its own prediction. I was more testing its ability to recognize the past, so I decided to make the third test much harder. Test 3. This time I moved away from the weekly time frame entirely. Instead, I chose a 6-hour chart taken from the middle of a trend. No famous bull market top, no famous bear market bottom. Just a much more random point in Bitcoin's history that hopefully would be much harder to recognize for the AIs. If Claude was generally that good at analyzing charts, this was its opportunity to prove it. 6 months later, Bitcoin was trading at roughly 114k. This time, the results looked completely different. Gemini got both the direction and the price wrong. ChatGPT correctly expected Bitcoin to move higher, but wasn't bullish enough. And Claude, for the first time, completely missed it. Its prediction was around 80k and its overall analysis pointed in the wrong direction. That completely changed my opinion. If I had stopped after the first 2 tests, I would probably have walked away with this believing that Claude was the best AI for predicting Bitcoin. But the third test told a very different story. Once the chart was less recognizable for Claude, it couldn't really get it as accurately as it did on the 2 first tests. None of these AIs outperformed the others. So what did I actually learn by doing this? AI is incredibly good at explaining technical analysis. You can give it a chart and it can analyze it in seconds. It can point out patterns you may have missed, challenge your own thinking and give you a different perspective on the market. But when I forced it to predict Bitcoin's future, it ran into the same problem as every other thing we have tested in this video. It couldn't do it consistently, at least not yet. To me, the biggest takeaway here is that AI isn't a crystal ball. It's one of the best research assistants we have ever had. It can make you a better analyst, but it can't replace the thinking. That has to come from you. So after testing technical analysis, some of the biggest names in crypto, and now AI, I was starting to think, could the answer have been sitting in economy this entire time? Let's find out. Earlier in the video, Raoul Pal argued that Bitcoin follows liquidity. If that's true, maybe then the answer isn't hidden on the Bitcoin chart at all. Maybe it's hidden in the global economy. So I decided to overlay some of the biggest macro indicators onto the Bitcoin chart to see if they could answer or even predict Bitcoin's biggest moves. The first one I wanted to test was M2. If you have been in crypto for a while, you have probably heard of this correlation between the M2 and Bitcoin. M2 simply measures how much money is in the financial system. It includes things like cash, bank deposits, and savings accounts. You can think of it as measuring how much money is available to flow into different assets. Bitcoin, on the other hand, has a fixed supply. Only 21 million coins will ever be available. The theory is simple. If the amount of money in the system keeps increasing while the supply of Bitcoin stays the same, more money is fighting for the same asset. Imagine there's only 10 apples in the entire world worth $10 each. Now imagine someone prints another $200. There are still only 10 apples, but suddenly there is much more money chasing the exact same asset. Bitcoin is the apple, M2 is the money. So I overlaid M2 directly onto Bitcoin's price history to see if the relationship actually existed. And honestly, it was much more interesting than I expected. Throughout much of Bitcoin's history, whenever M2 started trending higher, Bitcoin often followed a few months later. It wasn't a perfect relationship, and it certainly didn't predict exact prices, but it often acted like a magnet pulled Bitcoin in the same direction. What traders do is they forward this M2 money supply about 90 days. Then they expect the current price of Bitcoin over the next few months to follow the same direction as the M2. The problem with this is the most recent cycle looks a bit different here. Since around the 2025 market top, Bitcoin and M2 have moved in opposite directions. Why? The truth is, nobody really agrees. Some analysts point to the global trade war. Others argue that higher interest rates kept financial conditions tighter than expected. Some simply believe fear overwhelmed liquidity. When investors become generally worried, it doesn't matter how much money exits the system if nobody wants to take the risk. Whatever the reason may be, the relationship hasn't been as reliable as it once was. That doesn't mean M2 is useless. It probably just means it's better at describing the environment rather than predicting Bitcoin's price. So I moved to another macro indicator that people always talk about: interest rates. One of the biggest assumptions is that lower interest rates is better for Bitcoin. So I overlaid the federal funds rate directly onto Bitcoin's chart to see if history actually supported that idea. Surprisingly, I found multiple examples where the exact opposite happened. After the 2014 to early 2015 bear market ended, Bitcoin entered one of the biggest bull markets in its history. At exactly the same time, the Fed was raising interest rates again. Then after the 2022 bear market low, Bitcoin once again began a strong recovery while interest rates continued moving higher. On the other hand, there has also been periods where the Fed started cutting interest rates and markets continued falling anyway. That raised another question. If lower interest rates don't automatically make Bitcoin go up, why does the Fed cut interest rates in the first place? The answer has nothing to do with Bitcoin. One of the biggest things the Feds watch is the unemployment rate. When the unemployment rate is rising, it often signals that the economy is slowing down. That's usually when the Feds start considering to cut rates. But there is another side to this equation. Cutting rates also stimulates the economy, which can lead to inflation going higher. So if the unemployment rate isn't rising and inflation is still proven stubborn, it often doesn't make sense for the Feds to cut rates aggressively, because that could cause inflation to rise. Looking at all of this together, I came to one conclusion. Interest rates don't really predict Bitcoin at all. They provide context. They'll tell you whether you are generally swimming with the current or against it. They can help explain why markets behave the way they do, but they aren't very good at telling you exactly where Bitcoin is gonna reverse. Markets can ignore macro conditions for months, sometimes even longer. Bitcoin also has a relatively short history compared to traditional markets. So I wanted to take this idea one step further. When I overlaid interest rates onto the S&P 500, I found the exact same examples going further back. During the dot-com bubble, interest rates were already high when the market topped. Then once the Fed began cutting rates, stocks didn't immediately recover. Instead, they continued falling. The same thing happened during the 2008 financial crisis. Once again, the rate cuts weren't predicting the bottom. They were reacting to a weakening economy. But while I was comparing Bitcoin and the S&P 500, something caught my attention. Earlier in the video, Benjamin Cowen introduced Bitcoin's 4-year cycle, where bull markets have historically topped during Q4 of the post-halving year before entering a bear market throughout the following midterm year. That made me wonder if the stock market is as important to global markets as everyone says there are. Could there be any similarities between Bitcoin's 4-year cycle and the S&P 500? In every midterm year so far, both markets experienced an initial decline after Bitcoin's bull market top. We have already seen that happen again during the current cycle. But historically, there has often been another meaningful decline later in the year, somewhere between late summer and Q4. Interestingly, that's also around the same period where Bitcoin has historically been close to forming its bear market bottom. Now that doesn't prove that one market causes the other, and it definitely doesn't tell us exactly what is going to happen this time, but it was another example of history repeating across completely different markets. After spending hours comparing Bitcoin with macro indicators, one thing became clear. The economy isn't a crystal ball. M2 provides context, interest rates provide context, the stock market provides context. None of these could consistently predict Bitcoin's next move, though we could find some similarities with the S&P 500 and Bitcoin, but together they help explaining the environment Bitcoin is trading in. And after looking at charts, experts, AI, and now the economy, there was one thing I wanted to test. No more prices, no more indicators, no more AI, but history and time itself. After all these things we have been looking at, I kept coming back to one thing: history. We talked about earlier how Benjamin Cowen used this to predict the environment Bitcoin was about to enter. At the time, we only looked at part of it, the bull market tops. Historically, Bitcoin has tended to top around Q4 of a post-halving year. That alone was interesting, but I wanted to know something much bigger. How deep does this pattern of the 4-year cycle actually go? So I started comparing every completed Bitcoin cycle, not just the tops, the bottoms, the rallies, the corrections, the sideways price action. And one thing quickly became obvious. When it comes to Bitcoin cycles, I think time is much more important than prices. Most people become obsessed with price targets. Will Bitcoin reach 150k, 250k, or even 500k? But after all the research I have done for this video, I think this might be the wrong question to ask. Instead of asking what price Bitcoin is gonna be at, maybe we should ask when. Let's go back to those bull market tops. Every completed Bitcoin bull market has topped during roughly the same period, Q4 of a post-halving year. What happens next is even more interesting. Every single one of those tops has been followed by a bear market lasting roughly 1 year. Not exactly 1 year, but close enough that the pattern becomes difficult to ignore. That means the bear market lows have historically formed around Q4 of the following midterm year. And just like the bull market tops, those lows have also repeated roughly every 4 years. Now that's already useful. It doesn't tell us the exact day, but it gives us a period where history suggests that risk might be shifting. But it didn't stop there. I wanted to see if there were more patterns repeating throughout these cycles. Let's take the current 2026 bear market as an example. One of the biggest local lows so far came during early February. So I went back from here exactly 4 years. In early 2022, Bitcoin also formed a major local low around late January. Not the exact same day, but within roughly 2 weeks. Then I went back another 4 years, 2018. Again, a major local low appeared almost at the exact same time. Then another 4 years, 2014. Once again, Bitcoin formed an important low around February. Now, none of these dates are perfect. And honestly, if they were, I would probably be a bit more skeptical. Markets simply don't work with that level of precision. But what surprised me was how close these important turning points were to each other within a few weeks. The more I looked, the more examples I could find. Local highs, local lows, even some of the strongest rallies. Again and again, similar events appeared roughly 4 years apart. Now, does that mean you can blindly buy every 4 years? Not at all. Take June as an example. If you're watching this in early July, you can go back 4 years and notice that both 2018 and 2022 saw local lows around June, followed by a rally. But then you go back another 4 years from 2018 to 2014, and instead of a low, June marked a local top before the market continued lower. At first it might seem like the pattern breaks here, but I actually think this teaches us something much more useful. The lesson here isn't that June always has to be a local bottom. It's that June often marks a major turning point. Sometimes that's a low, sometimes that's a high. The exact direction still depends on the current market situation. But history suggests that it's a period worth paying attention to. And that's why this became my favorite framework out of everything we have tested in this video. It completely changes the way you think of Bitcoin. Instead of trying to predict an exact price, it gives you time windows, periods where history suggests something important is about to happen. Personally, I think that's much more useful, because nobody consistently buys the exact bottom and nobody consistently sells the exact top. Even if someone does, it's usually more luck than skill. Imagine we are currently around 9 months into this bear market. History suggests that these bear markets tend to last around 1 year from the top. Instead of trying to perfectly time the exact bottom, wouldn't it make more sense to build a position slowly over the next few months using dollar cost averaging? That way you're not trying to time the exact bottom, and the prices you will get about 3 months before a bear market low is likely gonna look very good in a few years. Then as we eventually enter the next bull market, you can slowly start to reduce your position as we get close to that Q4 top historically. You don't need perfection, you just need probabilities. And this framework becomes even more interesting when you combine it with everything else we have talked about. As an example, earlier we talked about the 200-week moving average. Interestingly, Bitcoin tests of that level have also happened roughly 4 years apart. The same idea can be applied to RSI, to macro indicators, to historical support levels. Suddenly you're no longer relying on just one signal. You're building a plan using multiple pieces of evidence pointing towards the same period. Now I know some people believe that the 4-year cycle is dead. Maybe they're right. Maybe this cycle is finally the one where we break it. That's entirely possible. But after spending over 20 hours doing research for this video, I came back to the same conclusion. So far, Bitcoin's history continues to respect this cycle remarkably well. And until proven otherwise, I think this is one of, if not the best frameworks you can use. Just not in the way most people use it. Don't use it to predict prices. Use it to understand time. Because Bitcoin doesn't care if your price target is 200 or 500k. If the history suggests that we are entering a high-risk period, that's the information that deserves your attention, more than any specific number ever could. So can anyone actually predict Bitcoin? After researching TA, experts, AI, economics, and the history of Bitcoin, my answer is no. At least not consistently. Everything we looked at had flaws. TA is great at identifying trends, support and resistance, but it struggles to call the exact tops or bottoms. Macroeconomics helps explain the current market we are trading in, but it doesn't mean Bitcoin is gonna follow that. The experts that have spent decades studying these markets also admit that they are wrong sometimes. And AI, despite being pretty impressive, still couldn't predict Bitcoin consistently. But it doesn't mean that these tools are useless, quite the opposite. I think every single one of them has something valuable to offer. TA helps identify trends, macro helps explain the bigger picture, history gives us time windows, and together they create a much better framework than just relying on one of them or one person's opinion. Out of everything I researched, what impressed me the most was the 4-year cycle pattern. Not because it predicted Bitcoin's prices, but because it highlighted periods where Bitcoin has historically had turning points. Could that pattern break in the future? Absolutely. Bitcoin has a relatively short history, and none of us have a crystal ball, but until proven otherwise, I think that is the best framework to use. Not for predicting prices, but for knowing when to pay attention. The other thing that surprised me despite all the disagreements about timing, price targets and market cycles, Benjamin Cowen, Raoul Pal and PlanB, they all agreed on one thing. They are incredibly bullish on Bitcoin over the long term. Their short-term predictions might have been wrong sometimes, but their long-term perspective hasn't changed. And I think that's probably the biggest lesson I have learned making this video. Maybe the goal isn't to predict where Bitcoin will be in 2 months. Maybe it's to build enough conviction to stay invested over the ups and downs. If someone could predict Bitcoin's exact tops and bottoms, that would probably be one of the richest people in the world. None of us, of course, can do that. What we can do is use history, probability and good risk management to make better decisions. And if Bitcoin continues to follow this long-term outlook and 4-year cycle, I don't think people will regret consistently buying in 10 years from now. Because at the end, patience beats predictions, discipline beats emotion, and those two things historically have been far more valuable than trying to predict every top and bottom for Bitcoin. So if you enjoyed this video, remember to like and subscribe. Comment down below what I can do better. It's my first time doing a long video. Let me know if that's something I should do in the future or just keep them more short. And then I'll see you guys in the next one. Peace.